Australian rate cuts are over. Hi everyone and welcome to Ainslie Insights, brought to you by ainslie.com.au, the home of Ainslie Bullion, Ainslie Crypto, Ainslie Wealth and the Gold and Silver Standard. Be sure to have a look. Today, welcome back, Alex. A bit of a provocative title there, but it's a different angle from where other people are coming with this. How are you going today, Alex?
I am going well, very well.
Look, a fascinating article that you put together. You're worried about a few things. That's fair to say.
I'm not worried about anything this week, today.
Not worried about anything today. Let's say hypothetically worried about a few things. And a lot of this stems around this idea we've talked about before, potentially stagflation, issues we've got that could be popping up that are very similar to issues we've experienced in the past, potentially the 1980s. Talk us through what you're seeing on the horizon.
So the idea of no rate cuts is coming off the back of our inflation's on its way up and unemployment's on its way back down. So the read this week on job numbers saw unemployment go back down from 4.5 to 4.3%. Now, the RBA has two mandates, full employment and inflation between 2 to 3%. Well, we're above that in inflation, and if job numbers are coming down, there is no reason to cut. And unless the Aussie dollar strengthens at this point in time, because it is lagging behind everything, our inflation will keep picking up. So I would say to you, it is more likely rates go up from here, not down.
And that's certainly a call I'm not hearing from others, and it's similar in the US. Like, I worry about that expectation in the markets that there can be more cuts when I see, well, the inflation's picking up, if anything. I mean, when you talk about causes of this, you've been quite consistent in saying that the housing market really is the core of the problem because it diverts investment and labour away from more productive sectors. Like, this is something you've been talking about quite a bit. What is the relationship there that we need to be thinking about?
So you and I were talking about which country's worse in Australia. So I'll talk about Australia and then I'll tell you about one that's worse. So in Australia, investing money in housing, particularly if it's primary residence, there's no capital gains tax. The rate of return has been very good over time. So a lot of building and construction companies come in to build houses. So they take money out of what else can be invested in, as well as labour. And we keep facing labour shortages, and it's all moving to the houses now. There is an argument that labour that goes into housing is not as, I guess, technologically advanced. They're not putting their thought behind inventing things. They're putting their brunt behind building things. So we're falling behind, I guess, in innovation. I've spoken about that heaps. Productivity, housing is labour intensive. If you do something with AI, that's technology, manufacturing with robots, you can get more bang for your buck with the labour inputs these days compared to housing. And we continue to strip it away with all these generous incentives in the property market and nothing in our productive market. So then comparing which country's worse is New Zealand, who actually has capital gains tax on other things, but not on housing and investment properties. So they purely speculate on housing over there, and it benefits them because there's no capital gains tax or stamp duty.
And it's not even just close to home. I mean, this is pretty much a Western global thing, really, isn't it? Like, you're seeing this everywhere, that it's been about housing driving markets. We just particularly see it here because it's certainly been behind the Australian numbers for quite a while. I mean, it's very significant. Do you think that the other side of that, you mentioned about sort of the labour aspect, how does it play when you've got the jobs numbers coming out? Because they were quite high as well. And I mean, if that's part of the dual mandate or the multi-part mandate, it seems to be these days. But if that's part of the mandate as well, that would be leaning against rate cuts also, do you think?
Yeah. So where a lot of the information I got from the article this week is on a speech by Deputy Governor of the RBA, Hauser, who basically came out again last week and said Australia's in a great spot, but what he's worried about is with all our productivity declines and productivity per per capita not increasing over the last 10 years is that we are actually at full capacity. And this is what happened during the 1980s. And what that means is if we wanted to add units of output at this point in time with our labour and capital inputs, we're at full capacity. Labour is going up, as we know, with lots of immigration, but with the housing market taking capital away from the productive market, nothing's going into capital. So there's been a decline since about 2015 in capital investment because no business in Australia wants to invest in I guess, say manufacturing has like a 10-year horizon to probably pay its equipment back and make money. Well, the government changes its mind every 5 minutes. You don't have long-term governments, you don't have long-term vision, and so nobody wants to invest in what anyone's saying. I mean, I would argue that since our innovation started declining under Howard, he would have been the last Prime Minister in Australia with a long-term vision. And since then, investment has declined, innovation's declined, everything's declining. And unless we fix a vision for Australia into the future, there will be no capital investments in this country, and our productivity per capita will continue to decline. And that is what Hauser was arguing about, that we are just like the 1980s. We have full employment, inflation's going up, and we're at full capacity. So the only result, unless there's capital investment in this country right now, is stagflation.
It's really interesting. I was reading some opinion pieces, but talking about the Trump tariffs in the US, and highlighting that because recently some of those were coming off, like Trump had been talking about reducing some on food and things that aren't produced in the US. But they were saying, I think a point that you were making, that just because they come off doesn't mean all of a sudden businesses are going to rush to that area, because it's almost like the, once bitten, twice shy scenario where they go, well, we're not sure what it's like. There's uncertainty, so we're not going to ramp up production in that area anyway until there's more certainty, which will take time to reestablish. You can't just turn it on one day and then turn it off the next day and then turn it back on again. But also that really, the point I think people forget all the time is it takes a very long time to establish these things that build the productivity. Is that really what you're saying here around things like factories, for example? They don't come up overnight.
Yes, like we have to do it. We need capital, we need an investment. But if someone's not going to give someone a 10-year time frame to invest with certainty, so I'm not saying it's a factory, I'm saying it's a vision.
The vision that allows the factory. Yeah.
There you go.
That makes sense.
And we're not there. And, unless the government, we are, I believe, with our super, the second wealthiest per capita country in the world. We have so much money that we are forced to invest in super, and so much of it goes overseas. We do not invest in Australia.
So to wrap this up then, and this could be a bit more philosophical, I suppose, when you think about it, how do you balance that? If you're an individual, is it that you go down the angle you just suggested? So much of our super, for example, is invested overseas. Do you look at how you can personally redirect that? Like, it's easy to say there's nothing we can do as individuals, because obviously we're talking about whole macroeconomic systemic things, but how do you protect yourself here? How do you think about that from a personal perspective here? Because that's a bit of a tricky one.
I think from a personal perspective, people keep doing the right thing, which is gold and property at the moment, because unless there's a long-term vision from the government, that's what's going to happen. When they want to give one and they can give some certainty in this country, then possibly I would say to you, ask for your super to be invested in Australian companies. But until that happens, protect yourself with gold.
That's a fair answer. Until that happens, protect yourself first. And the way you protect yourself first is in assets you control. Yeah, that makes a lot of sense. Look, always love having you on to do these deep dives on these topics, because they are important to understand what's actually going on there. And it's really interesting to look at property, because it feels like one that has just been the, in quotes, no-brainer for people for so long, but there's real risks here to that market that I think people require a deeper thought than just, plowing because that's what everyone's always done. So, yeah.
Yeah, the rates to me are either steady or going up, and that is the risk around the property market. So unless capital gains outstrip that, which at 6% growth on property prices this year they are, but that can turn pretty easily when rates reverse and go the other course.
Makes a lot of sense. Look, thank you for your work on that as always, Alex. Really appreciate it, and we'll talk to you again soon. Thank you.
Thanks for having me.
Thanks everyone for watching. We'll chat again soon.